Mr. Khan is at his office on a Friday evening, working late on some files. To his great surprise, Kumar and Rocky have come to visit him. "Hello, what a pleasant surprise. What brings you to my office?" says Mr. Khan. "Well," says Kumar, "you know the various mutual funds you advised us to invest in?" Haven't they been profitable?" asks Mr. Khan with concern. "Actually, the problem is that they have been super profitable," says Rocky. Mr. Khan is puzzled. "I don't understand." "The thing is, we now know how to invest, but we don't know about how the returns from these are taxed," Kumar replies. "Ah, I get you. Sure, I will run a little class on taxation on capital assets for you when I'm done for the evening. But the precondition is that you will have to solve some problems with me," Mr. Khan smiles. Kumar and Rocky exchange alarmed glances, but agree anyway. The investment you hold in mutual funds are known as capital assets. Stocks, bonds, real estate, etc. are all known as capital assets. When you sell them for a profit or loss before a threshold period, they are known as short-term capital gains. When you sell them after the threshold period, they are known as long-term capital gains. There are certain rules on taxation of capital gains. If you have invested in equity or hybrid funds for less than a year, these gains are called short-term capital gains, and the gains are taxed at 15%. If you have invested for more than 1 year, these gains are called long-term capital gains, and you are charged 10% if the gains you made are more than 1 lakh. Khan says, "Kumar, now I want you to come up and solve this." Mr. Ajay has invested in equity mutual funds on the 1st of April 2018 for 1 lakh at a 10 rupee NAV, and the number of units was 10,000. What will happen if he sells all the units, that is 10,000 units, after 1 year, the 1st of December 2019, at an NAV of 25 rupees? The total sale proceeds would be 1.5 lakhs. "That's right," Mr. Khan says, "and the exempt limit on long-term capital gains, LTCG, is 1 lakh rupees. So the remaining 50,000 rupee gain will be taxed at 10%. If you have invested in debt, the capital gains works as follows. Short-term capital gains are taxed as per your income slab and is applicable on investments sold within 3 years of purchase. Those debt funds sold after 3 years qualify for long-term capital gains, which are taxed at 20% with indexation." Mr. Khan says, "Rocky, your turn." Rocky limbers up and picks up a piece of chalk to solve the example. "Now, let me give an example for short-term capital gains, STCG. Mr. Vijay invested 5 lakh rupees on the 1st of January 2016 and sold it for 5.5 lakh rupees on the 1st of January 2017. 50,000 rupees is short-term capital gains, STCG, in debt mutual funds, which will be taxed as it was sold within 3 years. Assuming Mr. Vijay is the highest salary tax slab of 30%, then he will need to pay how much?" Rocky's hands hesitatingly write 15,000 rupees in the column. Mr. Khan says, "That's right, 15,000 rupees. For long-term capital gains, before we calculate the tax, we have to factor in indexation benefits. Do you know what that is?" Mr. Khan asks. Rocky and Kumar both shrug. "Let me explain this with another example. Suppose I buy a property this year and I need to sell it after 3 years. According to this clause, you can adjust for the inflation and claim the benefit. So, if you bought it for 100 rupees this year and the inflation is 6%, and similarly in the next 2 years it is 6% each year, it will be 18% overall. By the end of the 3rd year, the cost of the property after inflation will be 118 instead of 100 that you bought it for. So, if you sell it for 120 after 3 years, then you will have to pay tax on 2 rupees, that is 120 minus 118. So indexation benefits accounts for the inflation. Debt funds work similarly. Now, time to solve a problem on this. Kumar, do you want to give it a try? Kumar vigorously refuses. Mr. Khan laughs and says, "Okay, I will solve this problem for you." Mr. Sam invested 5 lakh rupees on the 1st of January 2016 and sold it for 6 lakh rupees on the 1st of February 2019. Now, the indexed cost of purchase price as per CII 2541516 and CII 2801819 will be 5,50,000 rupees. It is long-term capital gains, LTCG, in debt mutual funds as it was sold after 3 years. So the long-term capital gain which will be taxed will be 50,000 rupees. Kumar jumps in and finishes the sentence as Mr. Khan pauses to get a response. Mr. Khan nods and continues. Though Mr. Sam is in the highest salary tax slab of 30%, with indexation, the LTCG tax levied will be 20%, and that will come to 10,000. This time Rocky fills in proudly. Mr. Khan smiles and says, right. Both Rocky and Kumar nod. They completely understand all of this. Mr. Khan continues. Now, let me talk briefly about capital losses. Capital losses incurred on a mutual fund scheme can be adjusted against the capital gains earned on another mutual fund investment of the same year. This offset cannot be done against any other head of income. Short-term capital losses can be adjusted against both long-term and short-term capital gains. However, long-term capital losses can only be adjusted against long-term capital gains. Also, you can carry forward capital losses for adjustment up to 8 assessment years. You can offset short-term capital gains from debt funds with short-term capital losses from equity funds. For the net amount of gain, you will need to pay tax as per slab rate. Is there anything else we need to know? Asks Kumar. Well, says Mr. Khan, I know I have given you a lot of information. I will close today's session with one last piece of information. Do you know what the grandfathered clause is? Kumar volunteers. Something about grandfathers? Mr. Khan laughs out loud. Not really. It's a clause which says that all the long-term capital gains accrued on equity mutual funds until January 31st, 2018 will be exempt from taxation. LTCG on equity mutual fund schemes after January 31st, holding period more than 12 months, will be subject to 10% LTCG tax on gains above 1 lakh a year. Any purchase made in February or March 2018 will also be subject to LTCG if the holding period criterion is met. Mr. Khan says, now we are all ready to invest, profit, and calculate taxes. Meanwhile, Kumar chips in, and have a coffee at the end of a very long workday. All three of them laugh.